Thank you very much for taking time out of your busy schedules to attend KOKUYO Company Limited's full-year financial results briefing for the fiscal year ended December 2025. I will now explain the summary of financial results for FY 2025, the full-year plan for FY 2026, and the progress of the fourth medium-term plan. Please refer to the presentation materials you have. I will begin with an explanation of our full-year FY 2025 results, followed by our full-year FY 2026 plan and the progress of the fourth medium-term plan. Finally, I will explain the results in each business. This slide briefly summarizes the key points as an executive summary. The results for the fiscal year ended December 2025 significantly exceeded the previous year's figures in terms of net sales, EBITDA, and operating income, and also exceeded the revised plan substantially. By segment, the furniture business generally progressed in line with the plan. Furthermore, the business supply distribution and stationery businesses saw significant growth by capturing special alternative demand due to distribution and system disruptions within the office-related mail-order business industry. Net income decreased year-on-year due to the reactionary impact of the gain from the sale of non-business assets recorded in FY 2024, but we achieved ROE of 8.4%. Reflecting our strong results, we increased the forecasted dividend by 1.5 yen from the most recent forecast to 24.5 yen per share, and we aim to achieve the consolidated dividend payout ratio of 50% set forth in the fourth medium-term plan. Next, I will explain the full-year plan for 2026. Through growth in each business, primarily the furniture business, we aim to achieve a year-on-year increase in net sales, EBITDA, and operating income. Net income is expected to decrease due to the decline following the gain on the sale of non-business assets recorded in the prior period. However, dividend is planned to remain at the same level as the previous period, 24.5 yen per share, based on our strategy for progressive dividend payments. The fourth medium-term plan made a smooth start in its first year. EBITDA expansion is making steady progress, and the overseas business is also achieving solid sales growth. We have established plans to utilize the 70 billion yen as growth investments. In the furniture business, we decided to invest in production assets and distribution facilities, while in business supply distribution, we decided to invest in systems and distribution facilities. We are steadily making progress in laying the groundwork for the future. Financially, we made progress in minimizing cash on hand and reducing cross-shareholdings, reaching our target of 5% or less of consolidated net assets. Now, I will explain the full-year FY 2025 results. Net sales reached 359.8 billion yen, EBITDA was 34.8 billion yen, and operating income was 26.2 billion yen, achieving both sales and profit growth. Net income was 21.4 billion yen, a year-on-year decrease in profit due to the reactionary effect from the prior period's gain on the sale of non-business assets. However, it exceeded the plan and we achieved ROE of 8.4%. This slide shows the contributors of year-on-year changes in net sales. Against the backdrop of the favorable office market, the Japanese furniture business drove the sales growth through increased order acquisition. Also, business supply distribution saw significant sales growth by capturing special alternative demand arising from distribution and system disruptions within the office-related mail-order industry. Overseas, although performance was weak through the third quarter due to market conditions in China, sales turned positive in the fourth quarter, resulting in a full-year increase of 1.1 billion yen. As a result, net sales increased by 6.2% year-on-year to 359.8 billion yen. Next, this slide shows the contributors of changes in operating income. All of our businesses in Japan, primarily the furniture business, showed an increase in profit. Overseas, there was a year-on-year decrease in profit, but the stationery business saw an expansion in their profit in the fourth quarter. As a result, profit increased by 16.5% year-on-year to 26.2 billion yen. Next, this slide shows the contributors of changes in operating income, broken down into gross profit and SG&A expenses. In addition to the sales growth in each business, gross profit increased by approximately 11 billion yen due to sales price revisions and cost reduction activities. Meanwhile, SG&A expenses increased by approximately 7.3 billion yen. This reflects proactive spending on strategic expenditures for future growth, such as personnel expenses and IT system expenditures, to promote and drive our medium and long-term strategy. Having absorbed these expenditures, we achieved a significant year-on-year increase in profits. Next, I will explain our cash flow performance. Cash flow from operating activities decreased by 2.0 billion yen, resulting in a positive 14.3 billion yen, due to a decrease in pre-tax net profit and an increase in income tax payments. Cash flow from investing activities decreased by 16.8 billion yen year-on-year, resulting in a negative 4.6 billion yen, primarily due to increased capital expenditures and a net decrease in cash from the sale of non-business assets. The primary contributing factors to the increase in capital expenditures include the renovation of the Shinagawa office and system investments in business supply distribution. The decrease in proceeds created by the sale of non-business assets is attributable to the impact of the major sale of land held in Aichi Prefecture during FI 2024. Regarding balance sheet performance, cash and cash equivalents decreased year-on-year due to negative cash flows from investing activities and financing activities exceeding cash flows from operating activities. While performance was strong, equity decreased due to factors such as the progress of share buybacks, and the equity ratio also declined. Next, I will explain the full-year plan for FI 2026. We plan to achieve net sales of 390.0 billion yen, EBITDA of 37.7 billion yen, and operating income of 27.0 billion yen. We aim to achieve substantial sales growth and higher profits at each profit level while balancing business growth with proactive investment. Net income is expected to decrease to 20.3 billion yen, primarily due to the reactionary decline of the gain on the sale of non-business assets recorded in the previous period. The overseas sales ratio, a key financial target of the fourth medium-term plan, is projected to remain at 13%, on par with FI 2025, while ROE is expected to exceed 8%. Furthermore, these plan figures do not include the impact of consolidating the Tianlong Group, which was recently announced. This slide shows the contributors of year-on-year changes in net sales. In Japan, we anticipate sales growth of 25.1 billion yen, primarily driven by the continued strong market condition of the furniture business and efforts by business supply distribution to retain new customers acquired in FI 2025. Overseas, we plan to achieve sales growth of 5.7 billion yen, primarily driven by the furniture business, reflecting the impact of new consolidation. As a result, we aim to achieve net sales of 390 billion yen, representing a year-on-year increase of 8.4%. Furthermore, if this plan is achieved, it will record a historical high. Next, this slide shows the contributors of changes in operating income. In Japan, the furniture business will continue to drive profit growth. However, due to increased depreciation expenses from upfront investments for future growth in business supply distribution, overall profit in Japan is projected to increase by 2.3 billion yen. Overseas, we plan to achieve an increase in profit of 1.4 billion yen as better margins are achieved across all businesses, led by the furniture business. Reconciliation is projected to increase by approximately 3 billion yen, and I will explain this later. As a result, we aim to achieve an operating income of 27 billion yen, representing a year-on-year increase of 2.9%. Next, this slide shows the contributors of changes in operating income, broken down into gross profit and SG&A expenses. In 2026, we plan to continue spending strategic expenditures to drive our medium and long-term strategy, with SG&A expenses expected to increase by 15 billion yen. This is primarily due to investments in human capital and increased depreciation expenses resulting from distribution and system investments. However, we plan to secure an increase in profit by increasing approximately 15.8 billion yen of gross profit through sales growth and an improvement in the gross profit ratio, thereby absorbing the increase in SG&A expenses. Now, I will provide additional information regarding the reconciliation of operating income. Reconciliation of operating income includes the elimination of intersegment transactions and corporate expenses. Corporate expenses primarily consist of costs related to administrative departments of the parent company headquarters that are not allocated to specific business segments. To achieve significant EBITDA growth during the fourth medium-term plan period, we will make upfront strategic investments. Specifically, these investments include M&A-related expenses, strengthening our global talent base, rebuilding aging core systems, and rebranding costs. As illustrated in the graph, we recognize these strategic expenses as necessary investments to drive future EBITDA growth and will manage them with discipline. This slide shows shareholder returns. Based on our shareholder returns policy for the fourth medium-term plan period, which calls for a consolidated dividend payout ratio of 50% or higher and progressive dividend payments, the year-end dividend for 2025 will be 24.5 yen annually, reflecting strong performance and representing an increase of 1.5 yen from the most recent forecast. For 2026, while we plan for a decrease in profit, we intend to maintain our strategy for progressive dividend payments and plan to pay an annual dividend of 24 yen and 50 cents per share, the same amount as FY 2025. We will also strive to achieve the 35 billion yen in share buybacks outlined in the fourth medium-term plan. Next, I will explain the progress of the fourth medium-term plan. We recognize that the fourth medium-term plan is making solid progress. EBITDA is also on an upward trend, and our overseas business is growing steadily. Regarding the 70 billion yen as growth investments, we have specific plans for its utilization, such as M&A and capital expenditures, and are steadily executing foundational steps for future growth. We will continue to grow to reach each financial metric. Each business in our business portfolio is making solid progress in improving itself based on its respective phase. We are promoting strategies aimed at reaching our 2027 targets and further enhancing sales growth and EBITDA margin toward 2030. I will now explain the overall picture of our growth investments. Under the fourth medium-term plan, we forecast a total of approximately 70 billion yen in growth investments. Of this, we plan to allocate about 50 billion yen primarily to capital expenditures and system investments aimed at improving the growth potential and profitability of existing businesses. We have set the budget for M&A investments at 20 billion yen, but we are also considering the possibility of investing beyond the outlook depending on prospective deals. In the furniture business, we have decided to invest in the Shibayama plant, Mie plant, and new Shiga distribution center. We aim for the Shibayama plant to serve as a production center for building materials, capable of producing a wide variety of products with high quality and high productivity. We aim for the Mie plant to serve as a production center for desks and chairs, driving our order-based manufacturing system going forward through strong cost competitiveness and technological capabilities. With regard to the new Shiga distribution center, we plan to consolidate distribution centers within the furniture business and position it as the central hub after consolidation in order to enhance productivity. These investments will enable us to simultaneously address the diversification of office furniture demand and also streamline production and distribution, thereby strengthening our ability to handle orders. We will implement system investments in business supply distribution to integrate the core purchase management functions of BenRe.net into the e-commerce site KOKUYO to promote our purchase management platform strategy. Also, we will invest in the distribution facility Tohoku IDC to streamline distribution. I would like to provide additional explanation of our purchase management platform strategy. Our purchase management platform strategy aims to achieve a procurement management platform that integrates multiple e-commerce sites to dramatically improve customers' procurement efficiency. We will migrate the purchase management functions previously provided through BenRe.net, an indirect materials purchase management system for large-scale corporate clients, into KOKUYO e-commerce site. By doing so, we will make these functions, which were previously limited to large-scale corporate clients, available to all customers. In addition, By further strengthening connections with major e-commerce sites and specialized trading companies, we aim to further streamline corporate procurement operations and strengthen operational control. This will enable us to build a platform that creates a virtuous cycle in which both connected suppliers and customers continue to grow. Next, I will explain the progress of our M&A initiatives. So far, we have disclosed the acquisition of KOKUYO Workplace India and the Tianlong Group Corporation as subsidiaries, and the acquisition and integration of 6 domestic sales companies. The acquisition of KOKUYO Workplace India as a subsidiary aims to acquire production and sales capabilities in India, thereby enabling early entry into this promising market. Through the acquisition of the Tianlong Group Corporation as a subsidiary, we aim to acquire a solid foundation in the writing instruments business while accelerating business expansion into the ASEAN market. Furthermore, the transaction is scheduled to be completed around November 2026. Through the acquisition and integration of 6 domestic sales companies, we aim to solidify the competitive advantage of our domestic sales network and achieve further growth and enhanced business continuity in our domestic B2B operations. This integration is scheduled for January 2027. Regarding KOKUYO Workplace India, PMI is making steady progress, and we are establishing the business foundation to promote our growth strategy. By combining KOKUYO Workplace India's strengths with KOKUYO's spatial design capabilities, we successfully expanded the KOKUYO brand's recognition, including winning the Best Booth Design Award at Orgitech India. Next, I will explain the progress of our rebranding efforts. KOKUYO began its rebranding in 2023. In 2025, marking its 120th anniversary, we also refreshed our corporate identity, including our logo. These initiatives resulted in a 23% increase in the number of fresh graduate applicants before and after the rebranding, along with a 5-point improvement in the challenge-taking culture score on our internal employee engagement survey. To achieve our long-term vision, we aim to strengthen new user touchpoints globally, foster employee growth and awareness reform, and enhance recruitment through rebranding. We will also work to strengthen the management foundation for future global growth and contribute to expanding enterprise value. Next, I will explain the progress of our financial strategies and capital policy. Regarding cash and cash equivalents, balances decreased due to the execution of proactive investments, the implementation of a 20 billion yen share buyback program, and the payment of cash dividends based on a 50% payout ratio. In 2026 as well, we will continue to carry out investments and shareholder returns in excess of operating cash flow, thereby further reducing our cash reserves. Cross-shareholdings have been steadily reduced, remaining below the target ratio of 5% of consolidated net assets set in the 4th medium-term plan. Regarding the analysis of the current cost of equity, we recognize an increase in cost of equity based on the rise in the risk-free rate and discussions with investors, and we estimate the cost of equity to be in the range of approximately 7% to 8%. By promoting the 4th medium-term plan, we will work to improve capital efficiency. Finally, I will explain the results in each business. While 2025 saw higher sales and profits in the furniture business, the performance fell slightly short of the targets of the revised plan. Net sales increased by 6% year-on-year to 172.1 billion yen. EBITDA increased by 6.3% to 28.9 billion yen, and operating income increased by 11.6% to 26.1 billion yen. In 2026, we will aim for higher sales and profits in Japan and in all overseas areas. Net sales are expected to increase 10.9% to 191 billion yen, EBITDA 19.5% to 34.6 billion yen, and operating income 17.3% to 30.7 billion yen. I will explain the details. In 2025, the furniture segment captured brisk office demand in Japan, achieving higher sales and profits. However, due to delays in orders and other factors, the performance fell slightly short of the revised plan. Sales price revisions, cost reductions, and the shift toward higher value orders are making progress, significantly improving profitability. Overseas, the segment saw sales growth driven by the consolidated operation of KOKUYO Workplace India and growth within ASEAN. EBITDA and operating income decreased year-on-year due to the impact of worsening market conditions in China and other factors. In 2026, we plan to achieve higher sales and profits in Japan through winning strong new-build office relocation orders. We aim to improve profitability by focusing on key products and new product launches, and by streamlining design and construction projects. Overseas, we plan to achieve higher sales and profits in India and ASEAN through high-value-added proposals, stronger product competitiveness, and enhanced supply capabilities. Also, in China and Hong Kong, we plan to achieve higher sales and profits by focusing on high-end customers and managing costs. By 2025, we carried out showroom renovations in major cities. We will use this as a springboard to win high-value-added orders. Also, we are actively launching strategic products like Duora 2 and Ingu Cloud, which are available globally, and we will continue to improve efficiency in production and assembly. Japanese furniture business has been growing steadily in the Tokyo metropolitan area, Kansai region, and other areas since the third medium-term plan. Starting in 2027, we will establish KOKUYO Marketing Japan by consolidating our domestic sales subsidiaries into a single entity. This will enable us to share the knowledge and proposal capabilities cultivated within KOKUYO, strengthen our organizational structure, and lead to sales growth and improved profitability. This will enhance the value we provide and strengthen our business in Japan. I will now explain the strategy to leverage spatial design excellence and talent outlined in the fourth medium-term plan. Through the strategy to leverage spatial design excellence and talent, we are strengthening our capabilities to increase opportunities to make proposals from the initial stages of office planning in order to realize our customers' work style needs. Through this, we aim to maximize order value, win rates, customer share, and customer retention. As an example, I will explain the whole building renovation service for company-owned buildings. This is a service that completely renovates small to medium-sized, aging company-owned buildings, covering everything from work styles to spatial design and operation. The first project will be the renovation of a tenant building owned by Enshu Railway Company, Limited. Business supply distribution significantly exceeded plans in 2025, achieving higher sales and profits. Net sales increased by 9.5% year-on-year to 108.3 billion yen. EBITDA increased by 12.7% to 7 billion yen, and operating income increased by 22.2% to 5.4 billion yen. In 2026, we anticipate a decrease in profit due to upfront investments, but we will strive for sales growth by focusing on retaining new customers and other initiatives. Net sales are expected to increase 9.2% to 118.3 billion yen. EBITDA is expected to decrease 6.1% to 6.6 billion yen, and operating income is expected to decrease 19.5% to 4.4 billion yen. I will explain the details. In 2025, the indirect materials and consumables purchasing management system BenReNet for large enterprises drove growth, and the acquisition of Fujitsuka Worko's business was also successfully completed. Additionally, due to changes in the external environment of the market for e-commerce mail-order office supplies, the number of orders and new customers surged. Through the agile response of the frontline workplaces, we were able to effectively capture the demand. In terms of strategy execution, we have made progress in system investments aimed at expanding our product lineup and improving the UI/UX of our e-commerce site, and have enhanced our ability to meet diverse purchasing needs. In 2026, we plan to achieve sales growth by retaining newly acquired customers through the consistent provision of stable services. On the other hand, we plan for a decrease in profits as a result of upfront investments in systems, distribution, personnel, and other areas in anticipation of executing our purchase management platform strategy. Regarding the purchase management platform strategy, we are strengthening our partnership with Monotaro, a supplier linked to BenReNet, and are making progress in expanding our linked suppliers. This includes initiating a partnership with Amazon Business that began in January 2026. For the stationery business, net sales in 2025 were on par with FY 2024, but profitability improved significantly, resulting in higher profits and performance exceeding the plan. Net sales were 83.5 billion yen, on par with FI 2024. EBITDA increased by 12.4% to 9 billion yen, and operating income increased by 18.3% to 7 billion yen. In 2026, we plan to achieve increased sales and higher profits by expanding our market share in each area. Net sales are expected to increase 1.6% to 84.9 billion yen, EBITDA 2.6% to 9.3 billion yen, and operating income 0.1% to 7.1 billion yen. I will explain the details. In 2025, despite stagnant market conditions in Japan, the stationery business saw an increase in profit despite a decrease in sales, owing to the success of its campus brand strategy and improvements in productivity. Furthermore, profitability improved as stationery demand shifted from the office-related mail-order business to B2C channels, resulting in significantly higher than planned operating income. Overseas, while the market downturn persisted in China, the segment achieved higher sales and profits by creating demand through the continuous launch of new products. In 2026, we will target the preference goods market as a common objective for all countries and work to create and expand this market. Preference goods are defined as products that propose meaning and experiences beyond mere functionality. Additionally, we will promote and drive our campus brand strategy, writing instrument strategy, and global notebook strategy in an effort to enhance operational efficiency. In Japan, the stationery business will work to sustain sales in its B2B operations while simultaneously growing its B2C operations. Additionally, we will establish Manabikata Lab to conduct research and verification focused on people's learning styles, thereby applying the insights we gain to stationery development. Overseas, we will work to expand the market share in India and ASEAN. In China, we will improve profitability through the introduction of writing instruments. I will now explain the progress of the campus brand strategy. Last year, we implemented a rebranding of the campus brand, transforming it into a learning style brand to support student learning. The number of stores carrying campus brand products has reached 915, achieving 150% of the target. In 2026, we will continue to introduce new products aligned with our study recipes that propose new ways of learning, driving the creation and expansion of the preference goods market. In the interior retail business, 2025 saw progress in initiatives across each segment, resulting in higher sales and profits in line with our plan. Net sales increased 11.5% to 23.6 billion yen, EBITDA 18% to 1 billion yen, and operating income 37.7% to 0.7 billion yen. Although we do not anticipate large-scale B2B orders in 2026, we plan to achieve higher sales and profits through improved profitability resulting from the review of unprofitable stores and improvements to store operations, as well as business expansion in the e-commerce and B2B areas. Net sales are expected to increase 1.8% to 24.1 billion yen, EBITDA 26.5% to 1.3 billion yen, and operating income 46.2% to 1 billion yen. I will explain the details. In 2025, the newly opened Newman Takanawa store is making solid progress. Also, in the online store business, traffic has been expanding, and the e-commerce sales ratio has been increasing. B2B operations also received large orders in the residential sector and made solid progress. In 2026, in the online store business, we will enhance customer lifetime value and increase the e-commerce sales ratio by improving our data infrastructure and visualizing customer insights. Regarding our physical stores, we will achieve both net sales growth and high profitability by implementing operational reforms and enhancing the merchandise composition of our private brand products. Additionally, for our B2B operations, we will accelerate the expansion of the Basement Hotel brand and enhance Poliform sales to drive a stream of contracts. With that, I will conclude my presentation. Thank you for your kind attention.